Are you looking for some good long-term compounders for you and your family? Are you looking for investments that are going to deliver both good income as well as powerful compounding capital gains over time? Stick with me today because I'm going to cover two of my favorite real estate investment trusts, or REITs. These are companies where I've been adding to my positions in the last several weeks, building them up a little bit. They are not super discounted at the moment, but I'm going to tell you why I think they're good value with a very brief overview of each company. Now stick with me to the end as well, because I'm also going to explain the two key metrics to watch when you're investing in REITs. So let's get into it today. Now, as I've explained in some of my recent videos, I have been primarily investing in the safer tranches of our family portfolio in the last several weeks, in the last several months really. I've been focusing on bonds and baby bonds. Now these provide long-term consistent income, and with the baby bonds in particular as well, there's also the opportunity there for reasonable levels of capital appreciation, particularly when I'm buying baby bonds that are going to mature in the next 3 or 4 years. So a large tranche of what I've invested in lately, and more money going into the investments, have been in that area. But another area as well has been really consolidating these long-term buy and hold investments, and particularly in REITs with some utilities as well. Now the big question might be why? What am I looking for here? Now one of the things that I do like about REITs is they often have a very nice mixture of the long-term income from the dividends that they pay out, but they also have long-term appreciation and growth. Now that's also really important. Now a key thing to remember here is that with a REIT, I am going to be looking for a REIT where there is AFFO, or adjusted funds from operations, the earnings per share. I'm looking for AFFO growth with time. What this means is the value of the share should increase as the amount of adjusted funds from operations, or distributable cash and earnings that the company has, as that grows with time, essentially the value of those shares will increase with time. Now, it's not a perfect correlation. Obviously, price fluctuates as the market goes absolutely crazy sometimes. But what I'm looking for is that slow and continual growth. Now, it's important to realize that they are not usually going to grow at, say, 20 or 30% per year for the AFFO growth. In fact, some of them are going to be much lower. And in some cases, only 3 or 4% per year. In other cases, 6, 7% per year. Now, there are, of course, outliers. There are some REITs which are heavy growers. They're looking to expand and grow that AFFO very quickly. An example of this would be Rexford Industrial in the Southern California area. I'll cover that off in another video soon. But slow, steady growers like Realty Income, we're not looking for double-digit AFFO growth. Instead, what I'm looking for is a mixture of current income from the dividend as well as matching long-term capital appreciation as they continue to grow. When I teach in the business school at the University of Otago, one of my key points of focus is always risk and risk. So you know it. When I'm looking at my personal portfolio, my family portfolio, I'm also very focused on risks and managing risks. Now for me, yes, I love my income, yes, I love my dividends, but I am not going to sacrifice this and take on undue risk and high risk for high dividends. So when I'm looking at this, I want a really good balance here. Now when it comes to REITs and this type of investment, I think one of the key risks is on debt. And the other key risk here is on getting into trouble with the dividend because of a high and elevated dividend payout ratio. Now I'm going to talk more about the dividend payout ratio at the end of this video, and I'll talk about debt and real estate investment trusts in another video soon. Okay, so we are on the Fast Graphs platform. Now as I go through and look at Realty Income, and as I look at Agree Realty, I want to look at a couple of key things here, and we'll be talking through a couple of points, some of the differences between these companies, but also what I'm looking for often. Now the first thing that we can do is we can actually take the price off here. Now this is, in my sense, my mind as an investor, this is actually what I'm interested in looking at. This orange line here represents the price to AFFO ratio. And we can see here that the AFFO is going up. So here, for example, USD 249, USD 265, USD 279, and we can see the adjusted funds from operation are going up. Now remember, the adjusted funds from operation are essentially like the earnings per share here. So this orange line is representing, for every share of ownership, an increase in the value of the earnings of the company, and for me that means an increase in the value of my asset. Now what we would expect to see is we'd expect to see then the prices to track that upwards trend, and we can see it's not perfect, but we can see fundamentally it is tracking that upwards trend there, that price in black. Now another thing to think about here is the fact that we've got this blue line here, the orange line, and the white line here on fast graphs. Now the white line is the dividend payments. Now that's also compared here to the AFFO on this particular screen, and this gives us here a sense of the dividend payout. Now in here, about 10 years ago, we were getting a dividend payout ratio quite high. That is much higher than I'd like to see. 89% was very much the limit of what I want to see, even on a well-managed company like Realty Income. But we can see here in the recent years it's decreased down to 76%, 75%, and here as well 76%. Now that's, in my mind, is a very safe level. Even if something catastrophic here happened with this orange line and it actually decreased closer to this white line, it's going to change this payout ratio, but it's not going to get to the point where I'd be worried about the company making any big moves or any poor business decisions to try and maintain the dividend, because they're running out of these earnings represented by the orange lines with which they're going to pay out those dividends. Now this blue line here, and this is what they call the normal PE. Now what it's basically saying here is in general, this PE ratio has normally traded at about 17.7 times rather than 15 times. So generally the markets and market participants, investors, have been prepared to pay about 17 to 18 times on a price to AFFO ratio. In other words, they're prepared to pay quite a bit more for the stock here. Now, some of the other key things to think about here as well is the dividend yield here is about 5.4%, and I can also get a sense here in fast graphs of what this dividend yield has been, and it's fluctuated from about 4.5% through to a fairly low 3.8%, but there have been times, particularly coming out of the great financial recession, the GFC, we can see here the dividend yield is actually much higher at about 6 to 7%, and now it's a very reasonable, I think, very healthy 5.5%. So I'm just going to take the dividend yield off. I'm going to take this normal PE off, and I'm just here looking at this line. Now what this would mean is any time I can see it dips beneath this orange line here, it's trading at quite a discount, and we can see historically here in the depths of the GFC it was trading at only 8 times on the price to AFFO ratio. Now currently it's trading at 13.8 times, which would seem to suggest if there was another big financial shock to the system, it could actually drop quite a bit potentially. But the key thing here is the drop from 13.8 to about 8 would be uncomfortable, but I'm in a much better position than if I was buying here at the peak and taking it from 23 times on a price to AFFO basis down to 8 times. That would indeed hurt substantially, and this is also the risk heading into the COVID pandemic here, paying an elevated amount. Now if I'd instead bought, for example, here and then held it down into the depths of the COVID crash, I actually only would have had a total annualized rate of return of almost zero. Even though the price has gone down here, the actual ability to recover some of that from the dividend payments would be powerful. And the fact that I was buying at a relatively good valuation means that the loss isn't too high. Now if you contrast that to instead, for example, if I had bought here, an extreme case, and I was holding it here into the depths of the COVID crash, my total annualized rate of return would be catastrophic. Now this really, in my mind, illustrates the principle that I don't want to overpay for a real estate investment trust. I want to instead be buying it as it approaches or as it is at or under this orange line. Now what this means is if I'd bought here and I held it through to about today, I'd be looking at a 8% annualized rate of return. And it's important to recognize that today it's not at a particularly elevated or rich premium valuation. On the other hand, if I'd bought at a less favourable time, for example right here at the peak, and I held it through to today, I'd be looking at quite a reduced annualized rate of return. And so that's an important principle. So fundamentally I want to participate in this orange line, this earnings line going up. I want to participate in the ongoing growth in the earnings of this company, in this case the adjusted funds from operation. So I want to buy when the stock level is at or around this reasonable purchase line here in orange. Now we can see here as well, most of this history here in the last 10 years, the price has traded above the orange line, and if we put this normalized price to AFFO ratio on here, we can see again it's actually currently trading a long way below what it's traded at in the recent past. Now if I wanted to compare this to, for example, Agree Realty, we can see here coming out of the global financial recession they actually cut their dividend. I think that was wise. The dividend payout here was 90%. And they cut the dividend payout, then it became 70%, and we can see here as well they maintained in the low 70s a very healthy dividend payout ratio there, which I'm not at all concerned about. We can see the strong, in the last 10 years, a strong continued increase here in the AFFO, here represented at a 14.13 times, and we can see it's normally traded at about 15 times. Now if I put the price on here, we again see a sort of a loose coupling, relatively loose coupling between the price and the AFFO. As prices stabilized here after the GFC, we saw the prices couple a bit more closely with the AFFO growth and trading up to a premium here. Now again, if I'm buying at the blue line and I'm holding it through to today, that looks like a 10% total annualized rate of return. If on the other hand I was buying substantially above the blue line, say here at the past about 20 times, and hold it through today, my total annualized rate of return has dropped quite a bit there to that 4.7 level. Now what this again is indicating is I want to be buying at reasonable value, and over decades, over years, as a long-term investor, we can see the prices were trading here at extreme premiums, and now though trading much closer to this orange line and this blue line here for Agree Realty, for ADC. So this is a reasonable time in my mind to buy. Now the dividend yield here is a little bit lower than Realty Income, and that's okay. Now I'm going to switch back to Realty Income and I want to look at a few other metrics. Now I use analysts and analyst estimates. Now what I've got here is the adjusted funds from operations and the analyst estimates for AFFO. Now looking forward in the 2-year forward projections, the companies hit the analyst expectations for AFFO 100% of the time, and 1 year forward 100% of the time as well. So this is, in my mind, showing stability. It's also showing that the company is honest and forthright in terms of the communications they're giving to marketplace participants and analysts, say in earnings calls. And it also suggests that the stability and this frankness about the communications enables the analysts to do a good job of estimating what those future AFFO levels are going to look like. Now as I then switch into the forecasting calculator and I look at this normal multiple, I'm going to look here about 2 years forward here, and here I've got 9 analysts reporting the AFFO expectations here. Now if prices return to this 19.17 times level and the analyst expectations for the AFFOs are met, then we're talking about potentially the prices increasing, AFFO increasing over the next several years, taking us to a total annualized rate of return, which is dividends as well as this appreciation, of about 27.5% per year, which I think is a very healthy, very good, nice, strong return. Now, I don't think Realty Income is trading incredibly cheaply, but I also do not think it is a bad buy. I don't think it's trading at an extreme premium either at the moment. It's not as cheap as it has been, but it's also not bad value in my mind. Now, another thing to look at here on Fast Graphs is it represents or shows us what the AFFO was 6 months ago and again what analysts are currently expecting it to be, and we can see it's stayed more or less the same in each of these cases here, though out to the end of 2026. Remember, there's only one analyst, so that's a bit more prone to fluctuations and variation. But looking at here, 9 analysts reporting to the end of the 2025 financial year, very stable estimates here for the AFFO, and we know that 2 years out, the analysts tend to get it right, so I would expect this to be a fairly good estimate for what the AFFO is going to be moving forward to the end of 2025. Now, what else is important? I'm looking at 2 key components here for my returns. I'm looking at both the dividends here, and we're looking at here estimated dividends of from 3.05 cents per year per share through to 3.15 through to 3.25, which is a very minor increase, I agree. But that's part of the increase. Is I'm looking at part of this as the value being returned by these dividends into my back pocket, but I'm also looking at this line here, which is this change per year in the fundamental earnings, the fundamental adjusted funds from operation here for the real estate investment trust of about 4.7% here estimated in 2024 and about 3.1 estimated here in 2025. So I'm looking at in total here a dividend yield of about 5.5 plus, say, next year about, or this year, sorry, about 4.7. So I'm looking at here 5.5 plus 4.7. I'm looking at roughly 10% expected return, comprising of 5.5% dividend yield here, as well as roughly what I consider to be about a 4.7% increase in the underlying value of the company because of the increase in the value of the AFFO, the essential earnings for my share in the company, that's going to be increased over this year. And again, we see that in 2025, another expectation of another 3%, plus the dividend yield, plus the fact that the dividend's actually expected to increase in that year. Now this, my friends, is what I'm looking for. A nice, steady 10% return, and if prices actually recover to a more favourable price to AFFO rate, then I'll be expecting an even better return here. Now, if I look back at the performance here, we can see here the dividend growth column. We can see in the last couple of years it hasn't had the strongest dividend growth in general for Realty Income. We can see very much single digit growth, but we can see the compounded growth rate has been about 4.7%, keeping up with inflation. I've got the dividends reinvested here, and we can see over this period as well that the compound growth rate with the dividends reinvested is more or less the same as the SPY, the S&P 500. Now, is this good? It's okay. It's going to be more volatile than the SPY. It's going to go up and down quite a bit more in terms of price. So we can see here, for example, prices are $70 in 2016, all the way down to below $50 in 2018. So if I was buying and trading in very unfavorably here, we're talking about a 30% decrease here during that period. So it can be very volatile, yes, but it also means it gives me the opportunity to say buy at this blue line and hold it with time, collecting nice dividend income and collecting a benefit from the growth of the company that I'm participating in as a shareholder. Now, Agree Realty, if I look through the same type of screens here on Fast Graphs, we can see here that they're not quite as favourable here in terms of the AFFO estimates and meeting these estimates from the analysts. We can see here that both 1 and 2 year, they're missing the analyst estimates, get it wrong, and the company performs worse than the analyst estimates about 8% of the time. But as we look through here, we can also see in the last 10 years, it's been pretty much bang on in both the 1 and the 2 year forward. So that's looking pretty good. So it's looking like most of these misses were in the distant past. And what this means in terms of the forecasting calculators is, again, I'm only going to go out till the end of 2025 here, and we can see again a similar annualized rate of return of about 23%, and that's comprised of dividends as well as capital appreciation as the prices rise back to this normal price to AFFO ratio of 20%. We can see here again there's a reasonable stability here in the estimates of AFFO particularly in 2024, and the estimates for 2025 have decreased fractionally, but very much, I think, very steady and stable. This is, in my mind, some nice potential returns here. Agree Realty has a slightly lower dividend yield. I can live with that. But let's also have a look at how they performed in terms of dividend growth, and we can see in the last couple of years it's been slightly stronger than Realty Income. How has it performed against the SPY? So reinvest dividends for both options have been enabled, and we can see again pretty much bang on. ADC has performed more or less on par with SPY, the S&P 500, so if you're an index investor you wouldn't have been missing out on money. Now the key thing here, I think, is while the total growth in the value of your account would have been the same if you'd made, these investments at the same time in each of these two investments, the key thing here is you can see here this is much higher total dividends reinvested in ADC, so your total return would be more or less the same. If I take off the dividend reinvestment, we can see as well here that the annualized rate of return without dividends is much lower, but the key thing is it's paid out substantially higher dividends over that time, giving me a very good income opportunity here in this type of investment. Now, when we're looking at this idea of dividend payout ratio, we can see both Agree Realty as well as Realty Income. We can see this dividend payout ratio is being kept in the 70s. Here, I think in Realty Income's case, you can see this gap here between the orange representing the fundamental adjusted funds from operation that they use to pay the dividend, and this white line. We can see this gap's actually been growing with the last couple of years, and I think that's very positive. What it's showing to me is that they're fundamentally adding an extra buffer here, and that's good. Now, where I think REITs can really get into trouble is this idea of this gap getting too small, this fundamental dividend payout ratio here, where the dividend is being paid out is almost the same level as the adjusted funds from operation. If that's happening, there's additional pressure on the management team. Now, another big issue here can be the amount of debt that the company's got. Now, we can see here that Realty Income has about 40% long-term debt to capital, but they've also got a very strong S&P credit rating of A-, which is a very good credit rating for a real estate investment trust. Now, if I flick over to Agree Realty, we can see, in fact, actually lower long-term debt to capital here, only about 30%, but a BBB S&P credit rating. Still reasonable, but a much more favourable, in my mind, a much more favourable long-term debt to capital ratio. Now, this is one of the things that's attracted me here to Agree Realty. It's got a very good payout ratio in my mind. It's got this ongoing expectation here for the adjusted funds from operations growth, low levels of debt, which means it's going to be more stable. Now, both Agree Realty and Realty Income are quite comparable. I think fundamentally, as I've said in some of the other videos, I think Realty Income, they've gone away from their core metrics, they've gone away from their core competencies, where they've really shown strength over the decades. I think Agree Realty is sticking much more strictly to the type of companies and the type of real estate opportunities that they are pursuing. I'll do another video on that later. And so I think this is a more pure and shall I say, a slightly higher quality portfolio here that's a bit more concentrated in the retail sector more than Realty Income, where even though they're classified as retail, they have, for example, recently acquired interests in casino and gaming properties as well. Now, I want you to switch over very quickly just to look at another case. So here we have Medical Properties Trust. Now, I've covered this quite extensively on the channel as well. As I've said in the last video, I have completely exited my positions. I'm not getting back into this. I'm no longer going to be investing in this. I am, however, going to talk about it. And here I think there's a couple of key points here to think about. Now, if I take the price off this chart, we can see as well it's a bit more volatile. It's dropped more here in the 2009 period, in terms here of the adjusted funds from operation. It dropped quite a bit. It took a while to get growing again. It leveled out here from 2015 to 2018. It surged after COVID a bit. Now it's dropped in 2023, and it's anticipated to drop more in 2024 and then begin to stabilize a bit. So it's not as smooth and it's not as nice in terms of compounding here in this AFFO level. Now, the other thing we can see here as well is this dividend payout level ratio. This dividend payout ratio has been in the 80s, 75 was looking good. Then as we see that the AFFO more or less stayed static, but we can see the dividend payouts were increasing. We can see they were hitting high 80s in 2018, into the 90s, almost 100% payout ratio in 2019. 90% roughly in 2020, began to look a bit more favourable. But one of the big problems that I think Medical Properties Trust has had is the fact that they've got a much higher long-term debt to capital. They've also recently had a drop in the S&P credit rating, and I think this has put them into quite a bit of strife and stress. And if you think about the decrease here, if they kept the payout here of $1.16 the same, and they were only having a AFFO of $1.27 per share, that would have represented quite an elevated level of payout ratio here in terms of the AFFO, and then I think that dividend payout level would have been very unsustainable. And in fact, we can see here, even if they'd held it steady, this dividend ratio here would have been well over 100% heading into 2024. Fundamentally, I think this dividend cut was a smart move, a good move. I would argue perhaps it hasn't even gone far enough, but that's perhaps a topic for another video. Now, the other thing to remember as well about this long-term debt-to-capital ratio is they don't have as good a spread of the maturity. In other words, they've got some massive levels of debt that are due in the next couple of years. The cost of this debt, the interest rate that they're paying on that debt is much higher than it was when they took it out. So if they had to refinance, roll that over, basically borrow that money again, as they will do when those debts mature, they'll be paying a much higher interest rate cost because of that. And that's not so good. Now, if you contrast that to Realty Income, they've got a slightly more staggered debt maturity schedule into the future. They do have a little bit more debt maturing in the near future here, but again, they don't have the same level of long-term debt to capital. They've also got a much stronger S&P credit rating, enabling them to get much better terms because of their size, because of their scope, because of their scale, because of this better credit rating. Now, Agree Realty, in my mind, is in by far the best position here. A very favourable, very safe long-term debt-to-capital ratio here, which I really like to see, even though they've got a slightly weaker S&P credit rating than Realty Income. What we can see from the debt maturity schedule is it is beautifully positioned. It is spread out. They have not too much debt that's going to be due in the near future, and we're not going to see any big instance in the near future as well where they're going to get hit by having to refinance and roll over some of this debt that they've taken on at unfavourable rates. And this is one of the reasons why I'm really attracted to Agree Realty at the moment, although it is, as I suggest here, by being pretty much bang on this blue line, it's trading very much, I think, at fair value. So it's not likely to return me with the best possible return over the next several years, but it is going to give me a nice dividend yield of about 4.85%, and I think this dividend is very safe with this very good dividend payout ratio here of 73%. Now, two of the key metrics that I'm going to be looking for when I'm investing in REITs. Number one is simply that AFFO growth that analysts are expecting. Now, yes, analysts do get it wrong from time to time. Analysts are not perfect, but they do understand the market. They do understand the trends. They understand the forces that impact on the success of these real estate investment companies. They follow these companies closely. They understand the strengths and the weaknesses of the major corporations in the space. They're not perfect. Analysts are not perfect. I'm not saying analysts are perfect, but I am saying I can use those analyst expectations to guide my investing decisions. And so I look very closely at these analysts' expectations for adjusted funds from operations over the next 2 years. I only look usually 2 years out. That's up to the sort of the limit that most analysts are going to provide those estimates for, with a level of reasonable reliability in most cases. So I'm looking for those analyst estimates. I'm looking for that continued growth. Now, as I'm looking at that, I'm also looking for a slowdown in the AFFO growth over time. Now, that would be a bit of a warning sign. If I'm looking at an investment and the growth and essentially those earnings, it's slowing down in the future, I don't want to pay as much for that investment today. Now, in a real estate investment trust situation, if I was looking at that type of investment, I would be looking for a much higher starting yield today, along with some dividend safety as well going forward. Now, another really important metric that I think is absolutely crucial to pay attention to in this space is simply the payout ratio. Now, the payout ratio gives us a sense of the safety of that dividend. Now, it's not quite as simple as it is in some other sectors. I do like to use a payout ratio here based on the AFFO. So essentially, what's the level of the dividend? What's the level of the AFFO coming in? And is there any safety there? Now, this is an important metric, and as we see these numbers close together, often as the AFFO comes down, as the dividend continues to increase or perhaps stays flat, that can put quite a bit of pressure on the boards as they begin to look at the options so that they can continue to pay a dividend. Remember, most of these companies, they are regarded as steady, stable dividend payers. If something happens to the level of that dividend, it can be quite a strong indication to the market and can precipitate quite a big sell-off. So we want to avoid that situation. And so I tend to look for a reasonable level of what I would consider to be dividend safety here. I'm looking for usually that nice AFF level to be quite a bit higher than the dividend paying out. Now, we'll look at a range of cases in other videos as well, but here in this particular case, I'm often looking for 80 to 90%. Once it goes above 90%, I'm getting very anxious. Once it's dropping too far down, I'm probably going to be looking at this rather as an income and capital appreciation vehicle. So I'm looking for a very low payout threshold here. They're probably keeping a lot of the funds that they generate, and they're probably reinvesting and cycling that capital into new property acquisitions. But generally, for a company like real estate investment trusts like Realty Income or Agree Realty, I'm probably going to be looking in the 80s as a reasonable level of dividend payout ratio there for safety. What do you think? I'm really keen to hear your thoughts on my overall match of real estate investment trusts. Does this match what you're looking for when you invest in real estate investment trusts? What do you think about Realty Income? What do you think about Agree Realty? Are these companies on your watch list? Are they already in your portfolio? Why and why not? Let me know in the comments down below, and I'll be sure to get in touch with you soon. Ciao for now.